Today, we're diving into the investment framework specifically tailored for real estate. One of the core components here is due diligence. Think of this as a disciplined process that helps us validate the true value of property while uncovering any potential risks. It's what allows us to make confident acquisition decisions. This process covers a broad range of factors, from reviewing the financials and title history to assessing the physical condition of property. We also analyze market dynamics to understand how the property fits within the broader market, and we consider tenant exposure to evaluate income stability. Doing this thoroughly ensures we have a clear, well-rounded picture before moving forward. The goal is not just to close any deal, but to close the right deal. This is where due diligence plays a crucial role. It helps us turn uncertainty into a confident decision by thoroughly verifying the income, uncovering any hidden liabilities, and ensuring that the asset genuinely supports the price, the financing, and the overall business plan. When it comes to price, due diligence confirms the true value, so we avoid overpaying. On the risk side, it helps us identify potential problems early, preventing losses down the line. And finally, due diligence strengthens our execution by improving underwriting and negotiation, ensuring the deal is solid from every angle. When conducting due diligence in real estate, it's essential to follow a comprehensive framework built around 5 key pillars. First, the financial pillar focuses on verifying the durability of income, expenses, and cash flow projections to ensure the investment makes sense economically. Next, on the legal side, we confirm that the property has a clear title, enforceable rights, and all necessary documents are in order to avoid any legal complications. The third pillar, physical due diligence, involves assessing the building's condition, identifying any deferred maintenance, and determining future capital needs. Market analysis is a fourth pillar, where we evaluate local demand, rental rates, vacancy levels, and how the property stands compared to competitors. Finally, operational due diligence reviews leases, vendor contracts, management systems, and the risks associated with day-to-day execution. Together, these 5 pillars provide a balanced and thorough review, helping us make informed decisions about the real estate asset. Let's dive into the financial review, which is a critical part of our analysis. It begins with underwriting based on key metrics that help us understand the property's value, leverage, and its ability to withstand downside risks. First, we look at ROI, or return on investment, which tests whether the projected cash flows are sufficient to justify the acquisition price. Essentially, it's about making sure the investment makes financial sense. Next is the cap rate, or yield at entry. This metric compares the net operating income to both the purchase price and current market pricing, helping us gauge the immediate income potential from the property. Then we have DSCR, the debt service coverage ratio. This measures how comfortably the property's income covers the debt payments. A higher DSCR indicates a stronger debt cushion, reducing financial risk. Finally, we assess NOI and occupancy, focusing on income quality. This step validates the reliability of recurring earnings, examines vacancy exposure, and checks operational efficiency, ensuring the property can consistently generate income. Together, these metrics provide a comprehensive view of the financial health and investment potential of the property. Here, we focus on 3 core methods used to value properties, each providing a unique perspective to determine the asset's worth. First, the income approach. This method values income-producing properties by converting the stabilized net operating income, or NOI, into a present value. Essentially, it looks at the cash flow the property generates and uses that to determine its value. For example, an apartment complex might be valued based on its NOI and the market capitalization rate. Next, the market approach. This one benchmarks the property against recent comparable sales in the area. Adjustments are made for key differences between the properties to arrive at an accurate value. For instance, an office building's price might be estimated by looking at sales of similar buildings nearby, based on price per square foot. Finally, the cost approach. This method estimates value by calculating the land value plus the replacement cost of the building, then subtracting physical and functional depreciation. It's particularly useful for special use properties, where value is assessed based on what it would cost to rebuild, accounting for wear and tear. Together, these 3 approaches, income, market, and cost, create a comprehensive framework to triangulate the most accurate property valuation. In this section, we're focusing on the legal and title review aspect of the investment framework. Before committing any capital, it's crucial to confirm that ownership is clear. This legal diligence helps protect against any defects that might affect the value of the property or complicate financing and future use. First, a thorough title search is performed. This involves verifying a clean ownership history, making sure all recorded transfers are accurate, and checking for any unresolved title defects that might cause issues down the line. Next, we look at encumbrances. These can include liens, easements, covenants, judgments, or any rights that could limit control of a property or reduce its overall value. It's important to identify these early to understand any potential constraints. Finally, zoning restrictions are reviewed. We confirm that the property's use is permitted under local regulations, check density limits, setbacks, and ensure full compliance with local land use requirements. This ensures that the property can be used as intended without unexpected legal hurdles. All these steps collectively give us confidence in the investment's legal standing and protect us from future surprises. A clean title is absolutely critical because it safeguards financing options, ensures transferability, and preserves the exit value of the property. To achieve this, a thorough legal review is essential, starting with a comprehensive title search. This helps us confirm that the ownership is clean, without any hidden claims or restrictions that could jeopardize the investment. We also verify the chain of ownership to make sure there are no breaks or irregularities. It's important to conduct lien searches to check for any outstanding debts or claims against the property. We look into easements and encroachments, which could affect how the land could be used, and investigate any boundary disputes that might cause future conflicts. Lastly, ensuring zoning compliance guarantees that the intended use of the property meets local regulations. All these steps are vital to protect the investment from legal and financial risks down the line. When we talk about on-site validation, the focus is not just on what looks good during a quick walkthrough. Instead, we need to inspect the elements that truly drive near-term capital expenditures, safety exposure, and the overall durability of the asset. This means diving deeper into several critical areas. Starting with the physical inspection and condition review, we look closely at the structure itself. Key points here include checking for foundation movement, evaluating the roof's integrity, watching for any signs of water intrusion, and identifying visible cracking or settlement issues. These structural factors are crucial because they impact the long-term stability and value of the property. Next, we evaluate the systems. This covers HVAC, electrical, plumbing, elevators, and any deferred maintenance. These systems can often be overlooked, but they aren't functioning properly. They can lead to significant disruptions in operations and unexpected costs down the line. Finally, we assess life safety elements. This includes fire protection measures, identifying any code deficiencies, unsafe conditions, and understanding how urgent remediation might be before closing the deal. Ensuring that these safety elements are addressed is vital to avoid liability and ensure occupant safety. Overall, this comprehensive inspection review helps us get a real understanding of the property's condition, potential risks, and immediate repair needs before moving forward. When we talk about the decision lens and environmental assessments, it's crucial to understand how environmental findings can significantly impact various aspects of a deal. These findings can influence the price, affect indemnities, alter financing options, and even determine whether the deal is viable at all. The risk review we perform focuses on confirming whether there are any hidden site conditions that might lead to cleanup costs, liability exposure, or delays in closing and redevelopment. Key environmental concerns are addressed through a structured assessment process. First, the Phase 1 Environmental Site Assessment, or ESA, involves reviewing historical records, conducting a site reconnaissance, and identifying any recognized environmental conditions. If the Phase 1 assessment reveals potential contamination, we proceed to Phase 2 ESA, which includes sampling and testing to confirm the presence and extent of contamination. We also pay close attention to hazardous materials that might be on-site, such as asbestos, lead-based paint, mold, underground storage tanks, or chemical storage. Finally, understanding the contamination history is vital. This includes looking into prior industrial uses, any spills or remediation activities, and reviewing relevant regulatory records. All these elements together help us thoroughly evaluate environmental risks and inform sound decision-making. Here, we focus on the key elements that form the foundation of our market analysis framework. First, supply and demand are critical. Understanding the balance or imbalance here helps us gauge market pressure. We look at inventory levels at current absorption rates, which tells us how much space is available relative to how quickly it's being leased. Next, comparable properties are essential benchmarks. Our data shows that we're at 97% of the submarket price per square foot, which means our asking rents are very competitive within this context. Speaking of rents, rental rates have grown by 6.8% over the past 12 months. This trailing growth is a strong indicator of market vitality and tenant demand, which could influence our assets' future performance. Economic indicators also play a crucial role. For example, we've identified a 3.1% annual job growth rate in the trade area, signaling a healthy and expanding local economy that supports demand for commercial space. Finally, our market analysis framework is designed to pressure test the asset against these four external signals: supply and demand, comparable properties, rental rates, and economic indicators before we finalize any underwriting decisions. This comprehensive approach helps ensure we have confidence in the asset's potential. Here, we're focusing on income security, which is crucial for maintaining stable and predictable cash flow in any property investment. To ensure this, we carefully review both the tenant and the lease agreement. This means validating the durability of cash flow by assessing the lease structure itself and evaluating the tenant behind it. Key elements we consider include the specific lease terms, which define the financial obligations and duration of the agreement. We also look closely at the tenant's creditworthiness to gauge their ability to meet rent payments consistently. Renewal rates are important too, as they indicate the likelihood of tenants continuing their leases, contributing to ongoing income stability. Finally, we examine the rent collection history to identify any past issues or delays, giving us a clearer picture of the reliability of incoming cash flow. All of these factors together help us assess and secure the income generated by the property. Here, we focus on the operational due diligence framework, which is crucial for ensuring the ongoing success and stability of a property after acquisition. First, we have property management review, where we evaluate the quality of oversight, the discipline in reporting, controls over vendors, and how responsive the service teams are. These factors directly impact the property's day-to-day operations and tenant satisfaction. Next, maintenance and capital expenditures. This area looks at deferred maintenance issues, reserve fund requirements, routine repairs, and any significant upcoming capital projects. Proper assessment here helps prevent unexpected expenses that could affect cash flow or property value. Then, we move to insurance and liability. This involves checking if coverage is adequate, reviewing the history of claims, understanding exclusions and deductibles, and identifying any gaps in exposure. Proper insurance safeguards the asset from unforeseen liabilities. Finally, staffing and systems. This includes analyzing on-site staff roles, payroll efficiency, the software systems in use, control mechanisms, and the continuity of processes. Efficient staffing and solid systems are essential for smooth operations and sustaining performance over time. Overall, this operational due diligence is about testing whether daily execution can protect net operating income, effectively control risks, and maintain strong performance well beyond the closing phase. When focusing on assessment, it's crucial to ensure there is adequate coverage with no hidden exclusions that could leave us exposed. We need to confirm several key aspects like the policy limits, any endorsements, claims history, and whether the coverage truly aligns with the specific risks related to the asset. When reviewing risk coverage, our goal is to make sure the asset is protected against the main threats that could negatively impact cash flow, value, or the certainty of any deals. For property insurance, this means looking at replacement costs, deductibles, and exposure to catastrophic events. On the liability side, we review risks related to premises claims, incidents involving tenants, and the adequacy of umbrella policy limits. Environmental risks also need close attention, especially any pollution exclusions, prior uses of property, and potential flood or mold hazards. Lastly, from a market perspective, it's important to consider factors like insurance cost inflation, whether the asset remains insurable, and any lender requirements that might affect the coverage. This comprehensive review ensures a thorough and accurate risk assessment. Let's talk about return metrics. Focusing specifically on the cap rate. The cap rate gives us a quick snapshot of the unlevered yield, meaning the income return on property, before we factor in any financing costs. It's an essential tool because it allows us to compare the income performance of different properties on a level playing field, before the influence of debt or other financial structures comes into play. Now, looking at some illustrated market benchmarks for stabilized assets, you can see that cap rates vary by property type and market. For example, multifamily properties in core urban markets typically have a cap rate of around 4.3%. Industrial properties located in major logistics hubs often sit at about 5.1%. Offices in secondary central business districts can be around 6.8%, while retail centers in suburban neighborhoods tend to have cap rates near 6.1%. Hotels and drive to leisure markets generally show higher cap rates, around 8.4%. It's important to remember that cap rates are a comparison tool rather than a definitive answer. Factors such as the quality of the asset, lease rollover schedules, expected market growth, and any required capital expenditures can significantly affect what a seemingly cheap or low cap rate really means. Lower cap rates often indicate stronger growth expectations and are perceived as lower risk, while higher cap rates can suggest higher risk or weaker growth prospects. To put it simply, the core formula for the cap rate is net operating income, or NOI, divided by the property's value. NOI is the net operating income after accounting for vacancy and operating expenses. Generally, a higher cap rate signals either more risk or less anticipated growth, or sometimes a combination of both. Understanding how cap rates work helps us analyze and benchmark properties effectively, guiding better investment decisions. Let's begin by looking at existing debt. It's crucial to fully understand what obligations are already attached to the asset. This includes reviewing the loan terms such as a maturity date and amortization schedule, as well as any covenants, recourse exposure, and assumption rights that might affect the asset. Equally important is understanding the interest structure, whether the rate is fixed or floating, the index spread, any reset provisions, and hedging requirements that could impact financing costs. We also need to be aware of any prepayment penalties like yield maintenance, defeasance, lockout periods, and payoff costs, since these can influence the timing of an exit strategy. Moving to new financing, it's important to size the next loan realistically based on lender appetite. This means assessing debt capacity by looking at supportable proceeds derived from net operating income, debt service coverage ratio targets, and stress-tested cash flow durability. We need to consider loan-to-value ratios carefully, comparing requested leverage to market norms and how sensitive the valuation might be under downside scenarios. Additionally, lender requirements such as reserves, guarantees, reporting obligations, escrows, replacement caps, and closing conditions must be factored in. Ultimately, this debt review process serves two key purposes: confirming that refinancing is feasible and understanding the true cost of capital. Within the investment framework, testing the deal against current obligations and any future borrowing constraints is essential before underwriting expected returns. This ensures we make informed, strategic decisions that align with both current financial realities and future goals. On this slide, we're focusing on key risk factors that can affect a property's value, delay closing, or even disrupt financing. First, we have title issues, which include liens, encroachments, and gaps in ownership. These can complicate the transaction and create legal headaches. Next, structural defects are critical concerns, especially problems with the foundation, roof, or other major systems. These defects can lead to costly repairs and affect the building's safety and longevity. Tenant defaults are another major risk, involving delinquencies, weak credit, or the risk that tenants won't renew leases as expected. This impacts cash flow and the property's income stability. Environmental concerns also pose significant threats, such as contamination, asbestos, wetlands regulations, or the expenses related to remediation. Each of these can add unexpected costs or liabilities. Market oversaturation is a broader risk factor where too much supply in the area puts downward pressure on rents and occupancy rates, limiting potential returns. Finally, zoning noncompliance covers use restrictions, required setbacks, or conflict with permits, which can restrict how the property can be developed or used. All these red flags are essential to screen for early, as they can impair the property's value, lead to delays, or even cause financing to fall through. Recognizing and addressing these risks up front is crucial for a smooth and successful transaction. On this slide, we're focusing on risk and compliance, which is fundamental in maintaining a safe and legal building environment. Starting with building code and compliance, it's essential to adhere to all regulations to avoid violations that could lead to fines or safety hazards. Core compliance checkpoints include critical areas like electrical systems and fire life safety, ensuring that all installations meet safety standards to protect occupants. HVAC systems, ventilation, and the necessary permits are also key, as proper air quality and authorized work are crucial for health and legal reasons. We must also consider ADA accessibility requirements, which guarantee that facilities are accessible to all individuals, promoting inclusivity and compliance with federal laws. Lastly, tracking open violations and their remediation status helps us manage and address any outstanding issues promptly, maintaining overall compliance, and reducing risk. Each of these elements plays a vital role in creating a safe, compliant, and well-managed building environment. When we talk about value in real estate, context is everything. Understanding the location is crucial because it directly impacts the property's worth. Let's break down some key factors that we need to review when analyzing a neighborhood or location. First, proximity to amenities is essential. Being close to schools, shopping centers, parks, and public transportation can significantly boost a property's appeal and value. Next, traffic patterns play a big role. Areas with smooth traffic flow are more desirable, whereas heavy congestion might deter potential buyers or tenants. Lastly, we need to consider future development. Upcoming projects or planned infrastructure improvements can increase a neighborhood's attractiveness and, consequently, the value of properties within it. So, by reviewing these factors, amenities, traffic, and development, we get a clearer picture of the location's true potential and the value it can bring. Here, we're looking at a market benchmarking analysis, comparing the subject asset to three comparable properties nearby. The key purpose is to see how the asking price aligns with factors like asset quality, location, and lease performance. The subject property is listed at $18.6 million, which translates to $312 per square foot. When we compare that to the comps, prices range slightly lower, from $16.8 million to $18.1 million, with price per square foot between $287 and $304. What stands out is that the subject property has a high occupancy rate of 96%, compared to the comps ranging from 88% to 93%. It also benefits from recent renovations completed in 2021, unlike some of the others which have deferred capital expenditures or average conditions. Plus, the subject and some comps are located in a prime corridor, while others are in less dominant locations. So, the premium we're seeing in price and price per square foot for the subject asset is justified by stronger occupancy and recent capital improvements, supporting its position in this competitive market. Overall, the subject is priced slightly above its peers, but this premium aligns with its superior attributes. Let's walk through the three scenarios we've outlined for our investment approach. Starting with scenario 1, the best case, we're looking at a timeline of 12 to 24 months. Here, we expect a fast lease-up, capital expenditures hitting the plan, and a favorable market window. The exit method would be a sale after we've achieved NOI growth and valuation compression. This scenario aims for maximum equity lift, delivering a strong internal rate of return, quick capital recycling, and minimizing execution drag. Moving to scenario 2, which is our base case, the timeline extends to 3 to 5 years. In this scenario, stabilization happens at a typical pace with normal market liquidity. We plan to hold the asset, operating through steady cash flow growth and moderate appreciation. The expected outcome here is that we achieve our target returns, balancing yield and risk while maintaining flexibility for disposition timing. Finally, scenario 3 represents the worst case, with a timeline exceeding 5 years. Here, we anticipate slower absorption, unplanned capital expenditures, and a softer pricing environment. The exit method in this case is refinancing to extend the hold, preserve ownership, and improve liquidity. This approach focuses on capital preservation, accepting lower returns but containing downside risks through the structure and reserves. The key takeaway is our exit strategy planning. We must underwrite the exit before purchasing the asset. By modeling all three scenarios in parallel, we clarify timing, capital structure, and downside protection up front. Our decision rule is straightforward. We proceed only if the base case is viable and the worst case remains manageable. This disciplined approach helps us optimize returns while controlling risk effectively. Here's the execution plan for our diligence process, broken down into a detailed timeline with key contingencies. We launch with document intake during days 1 through 3, gathering essential materials like leases, T12 financials, title reports, and surveys. Then from days 4 to 7, we conduct a thorough site inspection, assessing physical conditions, mechanical systems, and identifying any deferred capital expenditures. Between days 8 and 12, we perform a market and lease review, focusing on rents, lease rollovers, and tenant strength to understand income stability. Days 13 through 17 are reserved for the underwriting update, where we refine our net operating income, CAPEX forecasts, and debt sizing assumptions. Finally, by days 18 to 21, we arrive at a decision point to go forward, reprice the deal, or exit, culminating in the final investment committee recommendation. Now, throughout this process, we're prepared for contingencies tied to specific triggers. For financing, if lender proceeds, debt service coverage ratios, or rate terms deviate outside of our underwriting thresholds, we act by repricing, sourcing alternative debt, or terminating before the waiver date. For physical or environmental concerns, significant structural issues, major deferred maintenance, or environmental site assessments triggering red flags lead us to demand seller remedies, escrow funds for CAPEX, or exit the contract. On the legal side, unresolved title issues such as liens, survey conflicts, zoning restrictions, or gaps in lease estoppels will prompt us to extend review periods, revise terms, or refuse to waive contingencies. The key is to run our diligence sequentially, ensuring every contingency is linked to a clear, measurable trigger before we commit any hard money. This structured approach helps manage risk and keeps us aligned with investment criteria every step of the way. Here we have a metrics dashboard that gives us a quick overview of some key performance indicators for the property. First, the cap rate is 6.8%, which represents a yield on the current net operating income. This helps us understand the property's income relative to its value. Next is the cash-on-cash return, sitting at 9.4%, which indicates a return on the actual equity invested during the first year. Moving on, the debt service coverage ratio is 1.42 times, showing that the net operating income comfortably covers the debt obligations, an important measure of financial stability. The occupancy rate is strong at 93%, telling us that the vast majority of the space is leased and generating income. The average rent is $31 per square foot annually, providing insight into the rental market strength. Lastly, the days on market is 41, which signals a relatively healthy level of liquidity and how quickly properties are priced and sold in this market. Together, these metrics provide a comprehensive snapshot of income quality, leverage, leasing strength, and market liquidity. When evaluating any asset, it's crucial to gather a comprehensive set of documents before making a commitment. Financial documents like tax returns and operating statements give you a clear picture of the asset's economic health. Legal documents, such as deeds and the title report, confirm ownership and any encumbrances. Physical documentation, including inspection reports and permits, helps identify any structural or compliance issues. Operational records, like lease agreements and insurance policies, show how the asset is managed and protected. Skipping any part of this documentation increases the risk of missing important details. So, always ensure you have the complete record set to make an informed decision and avoid surprises later on. At this stage, we reach the decision gate where we carefully evaluate whether to proceed. The key here is making sure that value, risk, and execution align perfectly. We only move forward if the return meets our underwriting targets, meaning the financials support a successful outcome. It's also crucial that any material risks are either properly priced into the deal or adequately mitigated. Approval happens when the numbers hold up. We've thoroughly understood any legal and physical issues, and there is a clear closing plan with designated owners and contingencies in place. Once all these conditions are met, we decide on the next step, whether to negotiate, close a deal, or walk away. Finally, it's important to document this decision carefully and trigger the closing checklist to ensure everything is tracked and organized for a smooth closing process. As we wrap up, let's focus on the key takeaways from real estate due diligence. First, strong deals are the ones that withstand disciplined scrutiny. This means that the goal isn't just about moving quickly, it's about achieving certainty, accurate pricing, and controlling risk effectively. Always verify the income, expenses, and all your assumptions before you put faith in projected returns. Don't take anything at face value. Make sure to confirm the title, investigate any legal exposure, and ensure compliance before you commit. Because once you close, those risks become permanent. Physically inspect the property as well. Deferred maintenance can quickly erode value, so understanding the asset's condition is crucial. Additionally, test the market, know the tenant base, and have a clear exit strategy. Don't get caught up in just the purchase story or the initial appeal. Finally, if due diligence uncovers new risks, be prepared to renegotiate the terms, restructure the deal, or even walk away. Thorough diligence doesn't just protect your capital, it also enhances your decision making, leading to stronger, more confident investments.